Is retirement getting closer and closer and you're considering your options? Perhaps you've heard you can take your pension tax-free cash and draw down from the remaining funds. Well, in this idiot's guide, we're going to give you all you need to know on what pension drawdown is and how it works. Stick around to the end as I'll show you how you can potentially take more than the standard 25% of the tax-free cash from your pension. Drawdown, or Flexi Access Drawdown to give its official name, was introduced in 2015, and this marked a sea change in how retirees could take an income from their retirement funds. Essentially, Drawdown gives you full control over how much and when you can take lump sums or even income from your pension funds. You may have heard of this been referred to as almost like a bank account within a pension wrapper from which you can dip into it whenever you like. Big advantage of Drawdown, of course, is that it allows you to shape the income around your circumstances and that flexibility. So if you want to take more income during your active years of your retirement for more holidays, or if you plan on taking more income before the state pension kicks in, perhaps you can do so. Perhaps you want to take your tax-free cash and no income if you're still working and don't need that income from your pension. Well, Drawdown, it allows you to do this. The state pension age is 66 and rising to 67. But the rules around defined contribution or private pensions are different. Under current rules, you can access your pension from 55. However, this is set to rise to 57 in 2028. Further caveat though, if you have an existing private pension, you may have a protected pension age of 55. So it's always worth checking this with your pension provider, because if you do transfer it for whatever reason, this valuable benefit can be lost. Drawdown gives you complete control, as we've said, over how you can take your pension benefits. Usually though, whatever income you don't take is invested, and these remaining funds can hopefully grow and either offset any withdrawals that you do take or provide an income in the future. It's not technically correct to say that you can take 25% of your pension tax-free. That's because it's typically 25% of your uncrystallised pension funds. Well, the next question is, what are uncrystallised funds? That sounds very complex. Well, uncrystallised pensions in a nutshell are when you haven't taken any benefits from your pension. As your tax-free cash is based on 25% of your uncrystallised funds, not just 25% of the pension at the time you take your tax-free cash. If your uncrystallised funds increase, then your tax-free cash will in turn, on an absolute basis, although the opposite would be true if your pension fund went down. Let's see an example of a £100,000 pension. So when you come to take your tax-free cash, this crystallises your pension, which sounds extremely confusing. But bear with me. So let's use Del Boy as an example. So he takes all of the tax-free cash from within his pension, so he crystallises 100% of it. 25k will be paid to him tax-free, and the remaining £75,000 would still be within the pension, but it would be moved internally and be classed as crystallised funds. He can still take income from these funds or lump sums whenever he likes, but the income would be subject to income tax at his marginal rate. It wouldn't be a pension without some jargon, so the official name for a withdrawal of your tax-free cash is a pension commencement lump sum. I think I need some water after that. So if you take all of your tax-free cash, that makes sense. But what happens if you only take some of it? Perhaps you don't need it all. Do you lose the rest? So let's use the same example, but Del only takes £10,000 tax-free cash. When Del takes 10k tax-free cash, he crystallises £40,000 or 40% of his pension. 10k is taken as tax-free cash and paid to him, great. And the remaining 30,000 is designated to crystallise funds within the pension, which, if you remember again, he can still withdraw whenever he likes, but they will be subject to income tax at his marginal rate. 60% of the remaining pension is still uncrystallised, which means he can take 25% of this amount tax-free in the future. So as we know, if you take your tax-free cash or pension commencement lump sum, as the name would suggest, this is tax-free. However, if you take any income from the crystallised funds from your drawdown pension, then these withdrawals will be classed as taxable income. It doesn't automatically mean the withdrawal will be subject to income tax, as it will depend on your other forms of income. With current rules, the first £12,570 of your income is tax-free. If your earnings are above that, then the income will be taxed at the following rates, which you can see on the screen. Now, let's use another example. We're going to stick with Del though. So he's got no other income at the time he takes £10,000 from the crystallised side of his pension. as this is within the personal allowance amount, even though he's taken crystallised or taxable funds, the effective tax rate is a whopping 0%.
Hey, lovely, jubbly!
How about if a year later he becomes a millionaire, he's got rental income of 45k from his property portfolio in Peckham? Well, in this case, £5,270 would be subject to income tax at 20%, and the balance would be subject to income tax at 40%. You don't have to just take your tax-free cash as a lump sum or in one go. It's possible to take a series of smaller lump sums or even as an income. Let's see an example of how that can work. So Rodney, he's retired, got a pension again of £100,000 that's fully uncrystallised. So he needs 4k from this pension to cover his expenses and has turned to his private pension. He's a basic rate taxpayer already, so he gets his NHS pension of 20k a year. So if he took any withdrawals from the crystallised side of his pension, they would be subject to 20% income tax. Rodney can take a monthly tax-free cash withdrawal of £333 a month, 4k a year, to meet that shortfall. He's not going to be able to do it indefinitely, as he's going to eventually use up all of that tax-free cash of his. If we assume no investment growth, this will be in what? Approximately 6 years. It's possible to take a combination of your tax-free cash and taxable income from your pension to provide a tax-efficient or even tax-free monthly income from your pension. With this option, you can stipulate exactly how much tax-free cash you want and how much taxable income you want from the crystallised funds to make use of your personal allowance and shape the income around your own tax scenario. With this option, you could potentially take taxable income from your pension up to your personal allowance and then take the remainder from your tax-free cash. You may have also heard of an off plus, which is basically a withdrawal which is made up of 25% of your tax-free cash and the remaining 75% comes from your crystallised funds. Under current legislation, and assuming you've completed an expression of wish, most pensions do not usually form part of your estate when it comes to calculating inheritance tax. This can be extremely useful and powerful tool for retirees who may have other sources of income and the value of their other assets are above the inheritance tax threshold, such as their home or ISAs. The IHT threshold for most married couples, but not all, is typically £1 million. I've done a video around the limits of inheritance tax and how the allowances work, so if you haven't watched it, please do so here. So for couples who may have significant pensions but also other assets such as rental income or final salary pensions, they could leave the pension to grow and pass on to their loved ones after they're gone. Let's see how this would work with Del Boy. So Del Boy's got rental income of 45k a year again, which more than covers his expenses, and he already has an IHT liability as Mandela Property Company is worth well over 1 million. This could be useful for him and his family, as the pension could be passed on to his son Damien, resulting in a saving of potentially 40% inheritance tax. Damien can take the inherited pension flexibly once Del dies, and if Del died before 75, he can take any withdrawals tax-free from the inherited pension. If Del Boy died after 75, well, Damien can again take the benefits flexibly, but any withdrawals he takes from the inherited pension would be subject to income tax at Damien's marginal rate. It's worth highlighting that some rare pension schemes may just pay out the remaining funds to your estate when you die. So it's always worth checking this with your pension provider and regularly updating your expression of wish. So far, we've focused on the benefits of drawdown, such as the flexibility and how you can take an income from it, as well as the favourable death benefit. However, what are the disadvantages of drawdown? The first real risk of drawdown is that there are no guarantees, unlike an annuity. So if you take too much income from the pension, investment returns are poor, or you're just extremely unlucky and you retire before a severe market crash, there's a real risk that you could run out of money further down the line. One worrying statistic that I've discussed before is from an FCA study which found that the average withdrawal rate for those in drawdown was 8%. If this figure is correct and it's not just tax-free lump sum withdrawals skewing the figures, this is extremely concerning, as these withdrawal levels are just not sustainable over a time of 20, 30, 40 years or more. I've personally seen someone take a £100,000 pension uncrystallised in one lump sum and paid obscene amounts of tax, which also inevitably means they have no pension to provide an income in the future. As the remaining pension that is not taken as income is usually invested, if returns are much worse than in the past, this can also affect the sustainability of the pension fund. Let's see an example of how it can go wrong. So Phil is about to retire. He's thinking about going into drawdown and he's got a £100,000 pension. He's age 60, plans on taking 10k a year from the pension, which will increase by inflation and will assume his remaining drawdown pension grows by, let's call it 5% a year. In this scenario, the pension fund would run out at age 72, which, relatively speaking, is still very young. Yeah, he's still going to have a state pension with the full amount around £11,500 in today's money, but for most people, this isn't just going to be enough for a decent retirement at just under £1,000 a month to cover all bills, groceries, and actually enjoy your retirement. If you haven't taken any flexible benefits from your pension, or maybe you've only taken your tax-free cash, or you've in receipt of defined benefit pensions, then you can still contribute up to your annual allowance towards your pension to benefit from tax relief. I've made a video on tax relief which explores this in more detail, so watch it if you haven't already. However, if you take any flexible crystallised funds from your drawdown pension, then this will trigger something called the money purchase annual allowance. Basically, this means the maximum annual allowance that you will have is reduced to £10,000 a year and not £60,000. If you're retired or you have no salary or earnings, many people mistakenly think that's it. They can't contribute to a pension and get any tax relief. This is actually incorrect. If you're under 75, you can make a pension contribution of £2,880 and tax relief will be awarded, which will make the contribution £3,600, which is effectively £720 free money that I like to call. It's a really powerful tool many people aren't aware of and could be a useful option if you've got money elsewhere, such as in a savings account or an ISA, or you just have surplus income, which you could redirect to the pension to benefit and claim this tax relief. Not only can you benefit from this fantastic tax relief that you otherwise may not have got, but if you have an IHT liability, this can be a way of shielding more of your money. Drawdown can be a fantastic option, but if you're concerned about what's a sustainable income to take or how much you can take without running out of money, watch this video which looks at what might be a sustainable amount of income to take.